Ladies and gentlemen, thank you for standing by and welcome to the Utilizing Financial Market Signals to Predict Relative Asset Returns. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. I would now like to turn the call over to David Ranson. You may begin.
Yes, thank you. This is David Ranson, and thank you for participating. This is the third part of a three-part series of presentations concerning asset allocation. As you see, the title is Financial Market Signals to Predict Relative Asset Returns. So this is the third part of the series in which we attend to the question of prediction. In the first part of the series, 2 months ago, I presented some work showing how dominant the role of the economy, how the inflation rate and the growth rate of the economy as they evolve influence capital market prices. And in the second segment, about 1 month ago, I presented work showing that some assets are promoted by increasing growth, others by declining growth, some assets by increasing inflation, others by declining inflation. And so there were 4 possible scenarios of growth combined with inflation and 4 possible classes of assets, which we eventually identified with stocks, high-grade bonds, commodities, and gold. In the third part of this series of presentations is perhaps the most ambitious, in which we turn to the problem of prediction. And in the first slide, I'm showing where we left off 2 months ago, this classification of assets. You see here a scheme in which growth can be moving in an unfavorable direction or a favorable direction along the vertical axis. Inflation can be moving in a favorable, that is a declining inflation direction, or an unfavorable direction. And you see assets named in there. These are kind of characteristic assets, iconographic assets, you might say. Bonds, as you see in the northwest of the 4 quadrants, have 2 plus signs, meaning that bonds are favored by lower inflation, that is a favorable movement in inflation, but by an unfavorable movement in growth. In the opposite corner, you see hard assets have 2 plus signs attached, meaning that they're favored by both an unfavorable inflation outlook, that would be higher inflation, and a favorable growth outlook. Bonds, on the other hand, get 2 minus signs in that category. So hard assets and bonds behave oppositely. In the other 2 quadrants, we have stocks. In the southwest quadrant, stocks get 2 plus signs, a favorable growth environment and a favorable inflation environment. And in the final quadrant, opposite from stocks, stocks get 2 minus signs, but gold gets 2 plus signs, that is favored by an unfavorable inflation and an unfavorable growth environment. Let's summarize what we have come up with in the last couple of presentations. Asset returns relate, go on to Exhibit 2 here. Asset returns relate closely to the way an economy behaves, notably its rates of growth and inflation. Secondly, the key to asset allocation success is to choose assets toward which capital is beginning to flow and to avoid assets from which capital is escaping. 2 months ago, I said quite a bit about capital and the motivation which cause it to flow, but the basic argument is that if capital is flowing into an economy, it's going to promote the growth of that economy. If it's flowing into an asset, it's going to promote the price of that asset. So the key to asset allocation success is obviously to anticipate which direction capital is going to flow. And it turns out that it's very difficult to measure capital flows, especially in the aggregate. There are millions and millions of transactions to track. But the motivation behind capital flow is surprisingly easy to track and to measure. And that brings us to financial market signals. Financial markets issue signals which motivate and guide the direction in which capital chooses to flow. The fourth point we got then was, as a result, market signals, and 2 examples are credit spreads and currency fluctuations, have predictive power. Initially, they predict the capital flows themselves and the price performance of capital market assets. and then over a longer time frame, they predict the following consequences for growth and inflation in the economy. In Exhibit 3, we begin a series of slides in which I'm showing you the evidence from which these conclusions were drawn, and further conclusions showing how these market signals predict and to what extent they predict. This is, as I mentioned at the very beginning 2 months ago, it's not a theory. This is basically a set of observations about what history has to tell us and an attempt at a theory to put it together and make it sensible. So here is some of the evidence that observation showed. Historically, the growth rate of the entire world is strongly related to credit spreads. So here is some of the initial evidence. We see the widest credit spreads corresponding to the lowest growth rate 1 year in the future, and the narrowest spreads corresponding to the highest growth rate 1 year in the future. Let me explain what I mean by spreads here. You see the BAA and AAA grades are mentioned. Those are grades defined by Moody's, and I'm using Moody's data because they have the longest history. I believe Moody's is the oldest of all the credit agencies, and we have a history, some of which I'll show you, dating all the way back to 100 years ago. So the whole world is influenced by credit spreads, but we'll focus mainly on the United States. And in the following exhibit, you see a plot of the longest history that it's easy to find. It goes back before 1929 when the official statistics begin. We have data here covering about 100 years, and you see there in the upper line, the green line, the growth rate year to year in real GDP. The red line underneath it, which is obviously inversely related to it, is the change in this spread. I mentioned the spread between BAA bonds and AAA bonds. BAA, I should have mentioned, is, of course, the lowest grade, the lowest quality within the investment grade bond market. And these are U.S. data, but they're data for large U.S. corporations, super large U.S. corporations, which are clearly multinational, hence the effect on the entire world. Here we see an inverse relationship between the spreads and the growth of the U.S. economy, but notice that the spreads change. It takes place over a 2-year time frame, so it begins a year earlier than the growth shows up in the other line. So we're seeing here, in part, a predictive relationship between spreads and growth. However, there is a contemporaneous relationship as well, which I haven't excluded. This simply shows how strong the relationship is between the two variables. Only part of it is predictive, unfortunately. We go on now to another slide in which we can see how close the predictions are. This is a straight line relationship. The different categories are the changes in the BAA, AAA spread, very small increases and very large increases and large declines and everything in between. And you see here a clearly linear relationship, and it's linear relationships are what are really needed for predictive purposes. You should also notice, though, that I'm not using the basis point spread here between BAA and AAA bonds. Turns out if you do that, you get a curve and not a straight line. Very interesting, but it means that the ratio between the BAA and AAA, which gives you this straight line, is a better way to measure spreads for our purposes, for predictive purposes. Although it's very much more convenient to measure them in terms of basis points, it is more accurate for analytical purposes to measure them as changes in a ratio. In the following slide, we have a table showing 3 categories now, a large widening and a large narrowing in the spread and the intermediate case, and we look at equity performance across the world. All of these indexes are measured in dollars, so they're all on a level playing field, and you see vast differences between the consequences of a widening of spreads and a narrowing of spreads. Now I'm looking again at 2 different time frames. The performance of equities is measured over a 2-year time frame, so part of this relationship is predictive. The change in spreads is measured over a 1-year time frame. And then the final slide to show the evidence for credit spreads and their predictive power is the most complicated. In the left panel of Exhibit 7, we see the effect on the growth of the economy, allowing for a lead time of 6 months. We're now zeroing in on the right time frame to measure these things. The simplest way to look at the evidence is to look at one-year horizons, and everybody does that. But when you look at the predictive power of spreads, you find you get stronger relationships if you focus in on a 6-month horizon. The response in the growth of the economy takes place over a much longer period than 6 months, but the relevant information for prediction is the change in the B.A AAA spread over a 6-month time frame. And that's used again in the right panel of the same chart, but this time we're looking at the capital asset prices. There are 4 assets, as I mentioned earlier, different kinds of assets that perform differently under the different economic scenarios. And you see here that spreads, when they widen, favor 2 of the assets, the long T-bonds and the gold, whereas narrowing spreads favor the equity market, the S&P 500, and especially the commodities. So what we're seeing is that 2 assets are promoted by a widening of spreads, 2 assets are promoted by a narrowing of spreads, just the same symmetrical relationship we saw with the growth rate of the economy. So that's one of the market signals. There could be many market signals, but it turns out that spreads do such a good job of capturing the oncoming growth rate of the economy that we don't need a lot of other information which might provide similar kinds of data, similar kinds of insights, because credit spreads do enough of a job by themselves. And in the interest of keeping the model extremely simple, it turns out we only need one more market signal. We've covered the growth story here, and we need to cover the inflation story. More complicated in some ways. Looking at inflation in the next chart, Exhibit 8, we see a 200-year history. This is the history of the cost of living index, which is evolved into today's consumer price index, measured, of course, on a ratio scale, and the price of gold. All the different leading indicators of inflation can be compared and made to compete with each other analytically. It turns out that the winner from this process, as I've learned in my personal experience, is the price of gold. It's the earliest warning indicator of inflation. And over the long haul, you can see how it parallels the behavior of consumer prices. Now, consumers are operating in markets which are not liquid. Gold, of course, is traded in a market which is super liquid. So you wouldn't expect the two to correspond exactly on a day-to-day basis or even on a year-to-year basis. In fact, consumers are operating in markets which are primarily very sticky in their price behavior indeed, and the consumer price index is not measuring with any degree of promptness changes in market conditions. Nevertheless, over the long haul, of course, the two do converge. And we see this, if you analyze this further beyond this chart, one can tell that consumer prices tend to move towards where the gold price has already moved. Now, on a year-to-year basis, it's at first difficult to see any connection. If you were to look at a correlation between the change in the CPI and the change in the gold price, you'd be hard put to see a very reliable one. You'd see something. The inflation rate is highly persistent, and the gold price itself is also highly persistent. So we have to get rid of the persistence in order to see the relationship clearly, and we do that by differencing. So in these two charts, in Exhibit 9, we're looking at the accelerations and decelerations in the inflation rate. We're not looking at the actual inflation rate. And we're looking at the accelerations and decelerations in the change of the gold price. 4 categories here. You see in the left panel the regular, familiar headline consumer price index. We're dating the data go back to the 1950s in this chart. And you see a linear, straight line relationship with the changes in gold, which are the categories explained over on the right. And in the right panel, though, we're looking at the core consumer price index, which, if you watch it, of course, is extremely sluggish in its movements, and it's difficult enough to see a relationship between the CPI itself and gold, but to see a relationship between the core CPI and gold, or for that matter anything else, is extremely hard. Nevertheless, differencing is the answer, and if you look at the accelerations and decelerations in the core index, you again come up with pretty much an inverse relationship with the accelerations and decelerations in the price of gold. Several more pieces of evidence. First of all, in Exhibit 10, we carry the thing internationally. Here we have a bunch of developed countries. The same could be done for the emerging markets too, even more dramatic. But we have here a very large accumulated consumer price indexes over long periods of time. Here we're dealing with a time frame starting in 1972, so we have something like 40 years of data cumulatively, and then annualized you get the change in consumer prices on the vertical axis. On the horizontal axis, we do the same thing with the price of gold. In each case, we're measuring it in local currency, and it's also annualized. And then if you focus on the red dots, ignore the labels, which are just labels, but the red dots show where the data are. You can't miss pretty much a straight line relationship. Not only is it a straight line, but it's a straight line with a 1-to-1 or 45-degree slope. And it's the well-known phenomenon of purchasing power parity looked at from another aspect. It turns out when you analyze the gold price changes and the CPI changes, once again there's a lag. The gold price changes occur first and the CPI changes occur later. But if you look at cumulatively over a 40-year period like this, then the time lag becomes irrelevant, and you see basically a direct proportionality. Another piece of evidence it takes us into some other capital markets. Here I've divided the change in the price of gold in Exhibits 11 between large rises and large declines, and the intermediate case as well. And then I've looked at the following year corresponding movements, first of all in short-term interest rates and then long-term interest rates, or that's measured in terms of the return, the total return from holding T-bonds, and then the change in the S&P 500, the change in commodity prices. In all those cases, we have a one-year lag and a strong, very strong, impressive, pretty much a straight line relationship with gold. And then in the final column, of course, with the CPI, much longer lag. I've allowed for a 3-year lag here, and we still get a nice relationship with the change in the price of gold corresponding to the other columns. Finally, one of the most dramatic ways to show the impact that the change in the gold price has on other assets is to take the most important commodity in the world, the crude oil market, and we have a 60-year history for crude oil prices here plotted on a ratio scale. On the same ratio scale, I've plotted the price of gold. So in case of gold, it's dollars per ounce, but in the case of oil, it's barrels per ounce. It's dollars per barrel, and you can't miss the very close parallel between the two lines. It is so impressive that at first sight, it's not obvious that the ratio between them is moving very much. In fact, the ratio between gold and oil does move a great deal, but those movements in the ratio pale in significance relative to the broad movements in both of the numerator and the denominator. So we see here some strong evidence that the supply situation in the oil industry and the demand situation in the oil industry cannot be the major forces in pricing crude oil over long periods of time. It's clearly what's going on with the dollar because the supply conditions in the oil industry have nothing whatever to do with supply conditions in the gold industry. It must be the one thing that these two price histories have in common is that they're both measured in dollars. So what we're measuring is the variability, not so much of oil or of gold. We're measuring the variability of the dollar, and they obviously correspond very closely. Again, when you analyze this more closely still, you find that gold moves earlier and oil moves later. But that gets us into the prediction problem. In case of the equity market in Exhibit 13, show that the time lag can be quite long. I'm trying to simplify here, so I normally look at a one-year time frame for all of these different assets and both market signals, but we can't completely force the data into that very narrow stricture. And you can see here that the impact or the implications for the stock market over a two-year time frame are much, much stronger than they are over a one-year time frame following a change in the gold price. So we have to allow for the fact that the time lag in some assets may be longer than others. In the case of commodities, the impact on price takes place a great deal sooner, and in the case of equities, it takes place later. Rather unexpected in the light of efficient markets theory, but nevertheless, this is the actual evidence. Now we can see gold as market signal, summarizing it in a chart similar to the one I showed you before in which we use spreads. In the left panel, we're looking at large increases in the price of gold, declines in the price of gold, and intermediate movements in the price of gold, and looking at allowing for a 3-year impact in the consumer price index. We can see the relationship between the two. Then in the right panel, we look at the 4 asset classes that we identified earlier, and we see that 2 of them are promoted by a rise in the price of gold, 2 of them are promoted by a fall in the price of gold. As before, commodities show the greatest sensitivity. Well, in this case, gold itself shows enormous sensitivity. Now, this may be confusing to be using gold as an input into the model. Gold is also one of the output variables in the model. That's because the price history for gold is a predictor of the future, and they're both true. Gold is a market signal, but it's also an asset which is predictable from market signals, including its own past behavior. That's a serial correlation in the price of gold with which we are familiar. Now, in the next slide, 15, we show a slightly broader group of asset classes to emphasize how different the performance is in opposite scenarios. The B.A, AAA yield spread is measured along the vertical axis. A large increase is at the top of the graph, a large decline is at the bottom. The change in the price of gold is measured along the horizontal axis. So an increase in the price of gold is at the right, and a decline is at the left. And then we can classify annual returns on a bunch of assets, some of which we've already been looking at, and we see opposite behavior in opposite quadrants, as you might expect. Just to take one extreme example, the price of silver in the northwest quadrant, where it's out of favor because that's where safe havens do well and where financial assets do well. Silver being a risky asset, which is hard, can give us very low performance under those conditions. But in the at the bottom right quadrant, silver appears again, the same set of assets, silver being at the top with a very high positive rate of return. And we see throughout the data there shown inverse relationships between different scenarios. Another way to show it, it's really the same thing, but now in circular form. We can divide a circle like a pizza pie into 8 slices, or any number of slices, not merely 4. And you see here we can now start placing assets in categories, and not all of them fit perfectly into one of the 4 basic categories, which are the northwest and the northeast, the southwest and the southeast. For example, commercial real estate. Commercial real estate has to be placed in the eastern quadrant. This is all a matter of empirical evidence. There's no theory that tells us commercial real estate belongs in any particular place with any great confidence. But what the data tell us is that commercial real estate prices are not very sensitive to changes in yield spreads, and therefore that we can consider them to be neither in the north of the diagram nor in the south of the diagram, but in between. However, commercial real estate prices are very strongly related to the price of gold and all of the other indications of inflation. So we place commercial real estate in the eastern part of the diagram implying that a large rise in the price of gold is going to boost the prices of commercial real estate. C-grade bonds, completely different kind of an asset really, they happen to fall in the same place. But B-grade bonds, which you might have expected to behave like C-grade, don't. B-grade bonds appear in the south quadrant, along with master limited partnerships and the EFA index of stock prices for developed countries outside North America. B-grade bonds and C-grade bonds behave rather differently. If you plotted them on a graph, they would look similar, but if you analyze them, you find that B-grade bonds are very sensitive to the behavior of the dollar in terms of gold, or even the dollar in terms of other currencies, whereas C-grade bonds are not. I'm sorry, I said that wrong. The C-grade bonds are very closely related to the value of the dollar, changes in the dollar relative to gold, or relative to other currencies too. B-grade bonds are not. B-grade bonds are very sensitive to yield spreads. C-grade bonds are not very sensitive to yield spreads. So we can classify assets in this way, and we don't need a theory to do it with. We find out from their price histories how they have related historically to the earlier changes in the two financial market indicators, and therefore where they belong in a diagram like this. And having done this for asset classes, if we want to be more ambitious, we can move on, say, to countries. I have 2 or 3 examples of how this can be carried to a more detailed level, or disaggregation. And Exhibit 7 shows emerging markets. Of course, we all know that emerging markets are not all alike, but they differ not randomly, but according to the economic scenario in which we find ourselves. So we can draw the same diagram with the same change of the gold price, which is the US dollar gold price, along the horizontal axis, and the change in the B.A.AAA spread, vertical axis. It's exactly the same diagram, but we're looking at different kinds of assets to populate it. In this case, we're not looking at absolute returns. We're looking at the relative return from a particular country compared with the index of all the similar countries. So we're comparing, say, India with the emerging market index. And India shows up in the northern quadrant, or it's really an octant of this diagram. That is to say that India behaves, relatively speaking, as a safe haven asset in the emerging markets. Not something that one could work out theoretically, but something we can observe empirically. The opposite case, more relevant today, since spreads have declined in the past year or so, we're in the south of the diagram today, that would favor Eastern Europe and Jordan. I'm looking here at emerging markets. I haven't yet extended the analysis to frontier markets, but of course there are another 50 countries that could be added to the diagram. Another example would be the sectors of the U.S. stock market. The standard 10 sectors, and REITs could be added as an 11th sector, and we see that in Exhibit 18. Again, we don't have to redraw the graph. It's the same grid implicit in it, change in the gold price, change in spreads. We simply populate it with different assets. And again, as with emerging markets, we're looking at the relative performance of each of the U.S. stock market sectors using the S&P as the benchmark. So, and here the industry or the sector that shows up in the north of the diagram, the one that behaves like a safe haven, most unexpected, logically you might say, but the one that behaves best under those conditions where the spreads have widened and it doesn't matter what's happened to the change in the currency, information technology shows up. And in the bottom of the diagram, telecom is in the opposite case. Telecom is boosted by declining spreads. That would be relevant today. So information technology would be out of favor today by the same argument. And we see other sectors populating all the other slices, nearly all the other slices around the circle. Some assets, however, are insensitive either to the gold price or to the spreads. They might be sensitive to something else that we've left out of our model, but the sector that doesn't seem to be sensitive to either of them, and therefore for which we can't say anything, would be mortgage REITs. Finally, we don't have to divide those quadrants 4 ways the way we did, northwest, southeast, northeast, southwest. We can divide them diagonally. And it turns out that for some purposes, it's the diagonal framework. If we have a style bet for growth versus value, then growth can be favored in one half of the diagram and out of favor in the opposite half. Same thing is true of small cap relative to large cap. And what I've done in Exhibit 19 is to combine these 2 style bets. So we have 4 possible styles to choose among. And they correspond to the north, the west, the east, and the south of the diagram. South being the one that's most relevant today. As I mentioned, we've had a large decline in spreads, not so large a change in the gold price. So the spreads are dominating the picture today. That favors large cap value stocks. In all of these cases, we're allowing for a 1-year time lag from the movements in the market signals to the consequential performance of the capital assets. One more chart to show the wide universe over which this is relevant. We can look at other currency zones. For example, the the European Union, or the Eurozone. Using Germany as an example, we can see we can measure gold in terms of local currency, which would be euros for Germany, sterling for the UK, francs for Switzerland, and so forth. And you see there, we just indicated in a summary form whether the correlation with the particular indicator is negative or positive. So for Germany, say equities, German equities, the correlation with prior year movements in the price of gold measured in German currency is negative. And the correlation with prior year changes in spreads is negative. These are the U.S. spreads, I should say. All the German spreads data do exist, of course, but they're very much less copious and historical. And we don't really need the German spreads because the spreads in the U.S. bond market really apply to risk-taking all around the world, nearly all of the world. So we see here negative correlations for Germany just in the same places where we have already seen negative correlations for the United States. And on it goes. Same thing for the UK, same thing for Switzerland. So no matter which of the 4 currency zones we use, the dollar, the euro, the sterling, or the Swiss franc, we're getting the same sign to our correlations on a predictive basis, 1-year change in gold and the following year's change in domestic equities. Well, I could go on. This chart shows all the other asset classes as well, German bonds. Gold in Germany is really nothing different from gold in the U.S. And commodities, too, are traded in world markets. So in the lower half of the table, we're not looking at something that's particularly national, not German or British or Swiss, but we're using government bonds for Germany separately from British government bonds and Swiss government bonds in the second part of the table, and we're getting the same correlation structure as we got for the U.S. bond market. So at this point, I've given you a lot of material to digest. There's a great deal more that could be put out, but I've tried to cover the highlights. So here are the broad conclusions we can draw. Assets can be classified and their performance predicted according to the direction and sensitivity of their response to market signals. So we're bypassing the capital flows, but it's the capital flows that do the work. We simply don't need to track the capital flows. We only need to track the motivation behind the capital flows. That's the theory anyway. Secondly, 2 market signals, credit spreads and the gold value of the currency, which we measure as the price of the currency in terms of, the price of gold in terms of the currency, give us 4 economic scenarios and 4 primary asset classes. Thirdly, predictive success is found not only in the U.S. capital markets, but also those of other currency zones. Fourth, the product, now we've got it, is a simple structure. I've kept it extremely simple. not because the world is so simple, but because we can't understand it if we introduce complications too soon. So the product is a simple structure. It allows us to select among asset classes within, say, the U.S. currency zone or any other currency zone for that matter, but we can also use it for selecting among assets within asset classes, such as the sectors of the stock market and different countries in the emerging market or the foreign market universe. And that's where I'd like to complete the story. There's lots more material. You can share it with me. If you look at the last page of the slides, you'll see my email address, and you can write, and I'll provide whatever you would like in terms of the copies of the slides or any other slides that might be relevant, and written research reports that are tied in with the slides. So at that point, I'd like to turn it over. If there are any questions, I'll be happy to be here to address those. Thank you.
As a reminder, to ask a question, press star 1. Again, that is star 1 to ask a question. And again, ladies and gentlemen, if you would like to ask a question, simply press star, then the number 1. Okay, you do have a question from the line of Curtis Kimball.
Yes. Are there any correlation coefficients associated with your analysis?
Oh, yes. We publish correlation coefficients all the time in our written work. For presentation purposes, I don't necessarily display them, but if you want them, please write to me, and I'll send you written work. Explain what it is that you're looking for, and I'll send you the whatever you need.
I guess the real question was how strongly.
Well, they're all, I should say, I'm tempted to say they're all statistically significant. That's not quite true, but they're all, let's say, statistically interesting. Many of them are highly significant statistically. They tend to be less significant when you use the rates of return or the rates of growth in the economy, rates of inflation. If you use difference data, so you're looking at accelerations and decelerations, you get more highly significant correlations. And if you look at the return on one asset class, say it could be stocks, relative to another asset class which is very different from stocks, let's say gold, you get still more statistical significance in those correlations. So it's all a matter of how much you aggregate. The highest correlations occur at the highest level of aggregation, and as you'd expect, as you dig down and disaggregate, you're getting more ambitious, and so the correlations do deteriorate. That's there's no way to avoid that. But broadly, everything that I've been showing you is characterized by statistically significant or at least highly interesting correlations.
Okay, and again, that is star 1 to ask a question. Okay, it looks like there are currently no further questions.
That's fine. I'm okay to sign off, and I hope to present again at some time in the future, perhaps. Thanks for having me.
Again, thank you for your participation. This concludes today's call. You may now disconnect.